Hey everyone, and welcome back for another deep dive.
Oh.
You know how much I love digging into these market trends, and today we've got a really interesting one to unpack.
Oh, yeah. I'm all ears. Lay it on me.
All right, so this article from the Motley Fool caught my eye. It's called The S&P 500 Just Did Something It Hasn't Done in Over 4 Decades, and that could signal a big move in 2025.
4 decades. That's a pretty long time for the market to do something unusual. What's going on?
Well, the article highlights this trend where in 2024, only 28% of the stocks in the S&P 500 actually outperformed the index itself.
Wow. So the vast majority of companies didn't even keep up with the overall index.
Exactly. It means a tiny handful of companies were responsible for almost all of the growth.
That does sound like a pretty big deal. And it kind of reminds me of something.
Wait, let me guess. The dot-com bubble.
Bingo. You're on the same wavelength. The article actually draws a direct parallel to the late 1990s when a similar trend was happening. Just a few high-flying tech stocks were carrying the entire market.
And we all know how that ended up. Yeah, not pretty. But it's important to remember that history doesn't always repeat itself perfectly.
Right? Right, of course.
But still.
Makes you think, though, doesn't it?
It definitely does. It's a bit of a yellow flag, perhaps not a bright red one, but definitely something to pay attention to.
Okay, so maybe not a full-blown crash, but this concentration could signal a correction coming.
Possibly.
Yeah.
But here's something else to consider. After that dot-com bubble burst, a majority of S&P 500 stocks actually did better than the index between 2000 and 2005.
Oh, really? So even after that huge shakeup, the market kind of found its footing again.
It did. It suggests that even if we do see a correction, it could actually lead to a healthier, more balanced market in the long run.
Interesting. So it's not all doom and gloom.
Not necessarily. It's about understanding the potential risks and opportunities that come with these market shifts.
Okay, that makes sense. So what's driving this concentration in the first place? Why are just a few companies hogging all the growth?
Well, there are a few factors at play, but one of the big ones is the Federal Reserve's interest rate policies.
Oh, yeah, the Fed. What role are they playing in all this?
When interest rates are low, like they've been recently, larger companies have easier access to capital.
Meaning they can borrow money cheaply to invest in growth, giving them a leg up over smaller companies.
Exactly. It can create a bit of a self-perpetuating cycle. The big get bigger, while the small struggle to keep up.
That doesn't sound very fair.
No, it's not ideal, but there's a glimmer of hope. The article mentions that the Fed is starting to lower interest rates, which could level the playing field a bit.
Oh, okay. So that could give smaller companies a chance to catch up.
Potentially. It's a step in the right direction.
All right. So we've got this concentration, potentially a correction on the horizon, and the Fed trying to manage things with interest rates. But what does this all mean for the average investor? What are we supposed to do with this information?
Well, the article suggests a pretty interesting strategy, investing in an equal weight S&P 500 index fund. Ever heard of those?
Vaguely, but I'm not exactly sure how they work or why they'd be beneficial in this situation.
Sure. It's all about how the companies within the fund are weighted.
Okay, remind me how that works in a regular S&P 500 index fund.
In a standard fund, companies are weighted by their market capitalization. So the bigger the company, the bigger its slice of the pie.
Right. The giants get more say in how the fund performs.
Exactly. But in an equal weight fund, every company, regardless of its size, gets an equal weighting.
So it's like spreading your bets across the entire index instead of just focusing on the biggest players.
You got it. And historically, these equal weight funds have performed well during periods of market broadening, just like the one we might be entering now.
Okay, that's starting to make sense. So if I'm worried about this concentration, an equal weight fund could be a way to hedge my bets.
It's definitely something to consider. But we'll dive deeper into the specifics and potential pros and cons in the next part of our deep dive.
Sounds good. I'm definitely intrigued to learn more about this equal weight strategy.
Me too. There's a lot to unpack, and I'm looking forward to exploring it further with you.
Okay, so we're back. And I'm still thinking about this whole market concentration thing. You know, it's weird. We talk about the stock market being so vast with thousands of companies, but it seems like just a handful are really steering the ship these days.
It's a valid point. And it's not just about the sheer number of companies. It's about where the growth is concentrated.
Right. It's like we were saying earlier. If the S&P 500 was a pizza right now, a few massive slices are taking up most of the pie.
Perfect analogy.
Okay.
That uneven distribution is what makes some analysts nervous.
Yeah, because it reminds them of...
the dot-com bubble.
Of course. Exactly. That's the ghost everyone's seeing in the data right now. So the dot-com bubble is a good example of what can happen when market concentration gets out of hand.
Okay, remind me how that played out.
In the late 90s, investors were going crazy for internet companies pouring money into them, driving valuations through the roof.
Regardless of whether those companies were actually making money or even had a solid business plan.
Exactly. It was all about hype and speculation.
Like a house of cards built on dreams. Pretty much.
Yeah.
And when the bubble burst, a lot of those high-flying tech stocks came crashing down, taking the entire market with them.
Ouch. So I'm seeing the parallels here.
Right.
We've got this concentration, a few companies with possibly inflated valuations, and analysts predicting slower growth for the S&P 500 overall.
It's a recipe for a potential correction, even if it's not as dramatic as the dot-com crash.
Okay, so not a full-blown meltdown, but still
Yeah.
something to be cautious about.
Absolutely. But remember, market shifts, even corrections, can create opportunities.
Right. Like we were talking about earlier, after the dot-com bust, there was a period where most of the S&P 500 stocks actually did better than the index itself.
Exactly. It's like the market took a breather, rebalanced itself, and then allowed more companies to flourish.
Interesting. So maybe a correction isn't always a bad thing. It could actually lead to a healthier, more diverse market.
It's definitely a possibility. And that brings us back to this idea of an equal weight S&P 500 index fund like RSP.
Okay, RSP. I'm still trying to wrap my head around how that works. Can you walk me through it again?
Sure. Imagine you have, let's say, $100 to invest. In a regular S&P 500 index fund, a big chunk of that money would go towards the biggest companies like Apple, Microsoft, those heavy hitters.
Because they have the highest market capitalization. So they get the biggest slice of the investment pie.
Right. But in an equal weight fund, that $100 is split evenly among all the companies in the S&P 500, no matter how big or small.
So even the little guys get an equal share, giving them more room to potentially grow.
Precisely. And if we do see this market broadening where those smaller companies start to outperform an equal weight fund, could be in a good position to benefit.
Okay, that's starting to click. Now, even with this potential for market broadening, it's still important to remember no investment is risk-free,
Yeah,
right?
absolutely. RSP is just one tool in the toolbox. Diversification is key, and any investment decision should align with your risk tolerance and your financial goals.
Got it. So diversify, consider an equal weight fund, but do your own research and make sure it fits your personal strategy. What else should we be thinking about?
Well, we've talked a lot about the Federal Reserve and their interest rate policies. Remember?
Yeah, they're kind of a big deal.
They are. Their decisions can have a huge impact on the entire market.
Right, because low interest rates can give bigger companies an advantage. And the Fed is starting to lower rates now.
Exactly. Which could make it easier for smaller companies to access capital and compete. More of a level playing field.
So if the Fed keeps lowering rates, it could be good news for smaller companies and potentially lead to that market broadening we've been talking about.
It's a possibility. But here's the catch. The Fed also has to keep inflation in check.
Right, because if prices start rising too quickly, it could cause a whole other set of problems.
Exactly. So they have to strike a balance, stimulate the economy, without letting inflation get out of control.
It's like they're walking a tightrope.
A very delicate balancing act.
Yeah.
And their decisions have a ripple effect across the entire market.
Yeah.
So it's definitely something investors need to pay attention to. Got it. So market concentration, the Fed's moves, anything else we should be factoring in as we try to navigate these potentially choppy waters?
Well, the article briefly mentioned trade policies, which is an interesting wrinkle.
Trade policies, how do those fit into all of this?
Things like tariffs can actually impact inflation, which, as we've discussed, the Fed is trying to manage very carefully.
Oh, I see. So if a new trade policy leads to higher prices on goods, the Fed might have to adjust their interest rate strategy to counteract that, which then impact the market. It's like a chain reaction.
Precisely. It shows how interconnected all these factors are. Global events, political decisions, economic indicators, they all play a role in shaping the market landscape.
This is a lot to take in. It feels like there are so many moving parts, and it's hard to predict exactly how things will play out.
That's the nature of the market. It's constantly evolving, but that's also what makes it so fascinating. There's always something new to learn and analyze. True, it's like a giant puzzle, and we're trying to put the pieces together. But even with all this uncertainty, there are things we can do to navigate these market trends more effectively, right?
Absolutely. In the next part of our deep dive, we'll explore some practical steps you can take to position yourself for whatever the market throws your way.
Sounds good. I'm ready to dive into those strategies. Welcome back to the show. We've been on quite a journey these past two segments, haven't we?
We have. You know, with market concentration, the dot-com bubble, the Fed's role. It's been a lot.
It has. But you know what? I think it's been really helpful to kind of lay it all out like this, to see how all these pieces fit together.
Absolutely, I agree. And now it's time to shift gears a bit.
Yeah. Let's talk about what all of this means for you, our listener.
Right. Because at the end of the day, That's what really matters.
Yeah.
How can we use this information to make smarter decisions about our own money?
Exactly. We don't want to just throw out a bunch of theories and leave people hanging. We want to give them something actionable.
Agreed. So the first thing to remember is that there's no one-size-fits-all solution when it comes to investing.
Right. Every investor has different circumstances, different goals, different levels of risk they're comfortable with.
Exactly. So it's not about giving specific stock tips or telling everyone to run out and buy a certain fund.
It's about giving people the knowledge they need to make informed decisions for themselves.
Precisely. Now, with that said, there are some key takeaways from our discussion that we can all consider.
Okay, let's hear them. What are the big aha moments that you hope our listeners are walking away with?
Well, first and foremost, be aware of the potential risks associated with market concentration.
Right. Because when a small number of companies dominate an index like the S&P 500, it creates vulnerabilities.
Exactly. Those mega companies become like the pillars holding up the market. And if one of them wobbles, it can have a ripple effect on everything else.
So if a big chunk of your portfolio is invested in a traditional S&P 500 index fund, it might be worth exploring other options to diversify.
Exactly. And this is where that equal weight S&P 500 index fund RSP comes in.
Our SP. Our potential knight in shining armor.
Well, let's not get ahead of ourselves. It's not a magic bullet, but it's definitely a tool worth considering.
Okay, so remind us one more time why an equal weight fund might be a good strategy in this scenario.
Sure. In an equal weight fund, every company in the S&P 500 gets an equal share of the investment pie, regardless of its size.
So even smaller companies get an equal chance to grow.
Precisely.
Yeah.
And if we do see this market broadening where those smaller companies start to outperform an equal weight fund, could be well positioned to benefit.
Got it. But even if RSP sounds intriguing, you're not saying it's the only answer, right?
Absolutely not. It's just one option among many. The important thing is to do your research, understand the potential benefits and risks, and choose what aligns best with your individual goals.
Okay, so diversify, consider an equal weight fund, but do your homework and make sure it fits your personal strategy. What else should we be thinking about?
Well, we talked a lot about the Federal Reserve and their interest rate policies, remember?
Oh yeah, the Fed. They're always up to something.
Well, their decisions can have a huge impact on the market, so it's crucial to stay informed about their moves.
Like how quickly they're lowering interest rates.
Exactly. A gradual approach might signal caution, while more aggressive cuts could suggest they're trying to stimulate growth more quickly.
And those rate cuts can really affect smaller companies, right? Because lower rates make it easier for them to access capital and compete.
Precisely. So it's not just about watching the stock prices themselves. It's about understanding the economic forces that are driving those prices.
The bigger picture.
Exactly. Now, we also briefly touched on trade policies earlier.
Yeah.
And those can play a role as well.
Right, because tariffs can impact inflation. And inflation is something the Fed is trying to manage very carefully.
Exactly. It's all connected. Global events, political decisions, economic indicators, they all influence the market in different ways.
This is making my head spin. It feels like there's so much to keep track of.
There is, but that's also what makes investing so interesting. It's a constantly evolving puzzle.
And the more pieces we can put together, the better equipped we'll be to make smart decisions.
Absolutely. Knowledge is power when it comes to investing. The more you understand, the better off you'll be.
I completely agree. Well, I think we've covered a lot of ground today and given our listeners a lot to think about. Any final words of wisdom before we wrap things up?
Just this. Stay curious, keep learning, and remember that investing is a journey, not a destination.
I love that. That's a great way to put it. There will always be ups and downs in the market. But by staying informed and adaptable, we can navigate those fluctuations with more confidence.
Couldn't have said it better myself.
Well, on that note, I think it's time to wrap up this episode of The Deep Dive. Thank you so much for joining us on this exploration of market trends and potential investment strategies.
It's been a pleasure. And remember, folks, keep exploring, keep learning, and keep that investing mindset sharp. We'll see you next time.